All right, let's jump right into this explainer. Today, we're tearing down the physical reality and the financial nuts and bolts of PNC Infratech. We are looking at an infrastructure powerhouse that currently finds itself standing at a really crucial crossroads. Now, if you've been following the Indian infraspace, you definitely know this name. But today, we're going to look way past the headlines and dive directly into the data.
Here is our roadmap for today's teardown. First, business model and scale. Second, order book and execution. Third, financial ratios and valuations. Fourth, Q1 results and headwinds. And finally, future outlook and guidance. We're going to move from concrete physical assets all the way to abstract financial metrics, covering both the short-term bumps in the road and their long-term ambitions.
Okay, part 1, business model and scale, engineering the future. Let's start with a macro view of what PNC Infratech actually does on the ground and the sheer immense scale of their operations across India.
Look, the tangible reality of their business is just massive. They have successfully delivered 90 major infrastructure projects spread across 13 different Indian states. We're talking about incredibly complex, huge-scale engineering feats. And while they certainly dabble in various project models like hybrid annuity and build-operate-transfer, their absolute bread and butter is massive roads, highways, and expressways. They aren't just paving streets, they are literally shaping the physical connectivity of the entire nation.
Now, when it comes to their revenue mix, the dominance of that historical expertise is crystal clear. While they're actively trying to diversify into critical new areas like water infrastructure, which currently sits at about 12%, their core strength remains undeniably in roads. That road segment accounts for an overwhelming 88% of their consolidated revenue. So they are a road builder first and foremost, and their financial health is deeply, deeply tied to how that specific sector performs.
But what makes their business model truly unique? It's their self-reliant moat. You see, PNC isn't just a contractor that farms out all the difficult tasks to third parties. By strategically owning and leasing their own raw material quarries, and by keeping all the planning, design, and engineering entirely in-house, they maintain incredibly tight control over their supply chain. In the infra business, material cost spikes and delays can absolutely destroy your margins. So having this integrated capability lets them dictate timelines and optimize project costs from end to end. It's a massive advantage.
Moving on to Section 2, order book and execution. Let's look at this mammoth 220 billion rupee pipeline and see how it builds a foundation for their future cash flows. Past performance is great, but the order book is the true heartbeat of any construction company.
Over the years, PNC has built a formidable industry-wide reputation for finishing projects on time or very often ahead of schedule, and that reliability pays off big time. It's reflected right there in their robust, long-term credit rating of CAGR AA+. That high-quality rating is arguably the primary reason they're able to attract premium clients and aggressively expand their order book. Put simply, clients trust them to actually deliver on their promises.
But check out this deliberate shift in their unexecuted order book. We just saw that 88% of their current revenue comes from roads. Yet if you look at their future pipeline, roads only make up 62%. They are actively venturing into non-core segments. 25% of the pipeline is now in water, rail, and airports, and they've even carved out a 13% slice in coal mining. Management has explicitly stated they want 30 to 35% of future orders to come from non-road sectors. It's a very strategic pivot to insulate themselves against a slowdown in any single sector.
So that unexecuted order book, it stands at an eye-watering 220 billion rupees. To put that massive number into perspective, that represents nearly 5 times their expected standalone revenue for FY26. That gives them a phenomenal amount of revenue visibility. The work is out there, the contracts are signed and sealed. The only challenge left is simply executing on it without letting those margins slip.
All right, let's get into Section 3, financial ratios and valuations. With the physical business mapped out, it's time to crunch the historical numbers and look at the core financial ratios that dictate how the market values this company.
Looking at their historical performance, the consistency is just incredible. Over a 5-year stretch from FY19 to FY24, both revenue and profit after tax compounded at a remarkable 19%. EBITDA growth tracked very closely behind at 15%. I mean, in a notoriously cyclical and capital-heavy industry like construction, maintaining that kind of double-digit compound growth for half a decade is a serious testament to their operational discipline.
As of the latest reports, the market is valuing this entire execution engine along with that massive 220 billion rupee order book at a market cap of just over 5,750 crore rupees. Keep that valuation in the back of your mind as we compare it to their actual earnings.
Because here is a glaring juxtaposition. Based on trailing 12-month earnings, PNC is currently trading at a price-to-earnings ratio of just 6.9D. Compare that to the broader industry average PE, which is sitting way up over 30. This massive discount naturally prompts a lot of value investors to ask a very important question. Is the stock fundamentally undervalued, or is the market pricing in some significant future risks that aren't fully visible on the balance sheet yet? Drilling down into their core profitability metrics, they absolutely crush the industry averages. You're looking at a net profit margin of 15.49% compared to the industry's 7.69%, and operating margin sitting nicely at 18.90%. They are exceptionally good at extracting profit from the top-line revenue they generate. They're also trading below book value with a price-to-book ratio of 0.80, which is music to the ears of value investors. Now, their asset turnover ratio is a bit lower at 0.34, but in simple terms, that just reflects the heavy, capital-intensive reality of owning all that physical equipment and those material queries we talked about earlier. Which brings us to Section 4, Q1 Results and Headwinds, the crossroads. Because, as we know, no company operates in a vacuum, and recent quarters have thrown some serious headwinds their way, fiercely testing their resilience.
Take a look at this conflicting data from Q1 of FY27. On one hand, top-line revenue grew by a very healthy 18%, hitting 1,680 crore rupees. But, and this is a big but, despite that revenue growth, net profit actually tumbled by about 23%, dropping to 330 crore. So they are bringing in more money, but they're keeping significantly less of it. That points directly to intense margin pressures and rising operating costs.
So what exactly is eating into those profits? Well, the company's annual report literally calls this period a year of crossroads. They've been battered by external factors: prolonged monsoons halting physical work, a sluggish pace of new project awards from the government, and frustrating delays in receiving appointed dates. That essentially means they have won the contract, but they can't officially start billing for the work yet. This naturally puts a massive strain on their working capital cycle because you have heavy equipment just sitting idle while they wait for the green light. On top of that, they're dealing with some internal regulatory scrutiny, specifically a show cause notice from the NHAI regarding a pavement slippage issue.
But management isn't hiding from these issues. Managing Director Yogesh Jain clearly acknowledges the immediate pain these project delays are causing. However, he remains fiercely anchored to the underlying strength of that diversified order book. And he rightly points out that they are finally starting to receive those critical appointed dates, which means they can finally get shovels in the ground.
Finally, Section 5, Future Outlook and Guidance. Taking all of this into account, the massive backlog, the low valuation, and the immediate headwinds, how exactly does management plan to pivot back to aggressive growth?
This guidance timeline visually captures that crossroads concept perfectly. Management actually had to slash their FY26 revenue growth guidance down to a mere 5% to account for those delays we just discussed. But watch what happens next. They are banking on a massive snapback. They're projecting roughly 30% revenue growth in FY27 as those delayed projects finally come online and start generating cash, followed by another 25% growth in FY28, which would push revenue toward a massive 75 billion rupees.
For the financial analyst tuning in, let's do a quick intrinsic value check. You can see the sheer cost of funding this kind of massive scale. Their weighted average cost of capital sits at 15.39%, which is largely pushed up by a pretty high cost of equity at 26.73%. Essentially, capital isn't cheap for them right now. When you factor in their debt and equity to get their total enterprise value of nearly 87 billion rupees, the math dictates one simple thing. To justify this valuation, that projected revenue snapback we just looked at has to happen flawlessly.
So, I want to leave you with this final, completely objective data point. Across 14 different analysts, the average 12-month price target is 282.50 rupees. That implies an upside of nearly 26% from current levels. The fundamentals are undeniably there, the order book is absolutely stacked, and their historical margins have been excellent. But the ultimate question remains, can PNC Infratech successfully execute its new diversified pipeline and navigate today's regulatory and environmental headwinds to actually unlock that long-term value? Let us know what you think of the data. Thanks so much for joining us on this explainer, and we'll see you next time.